Hey, Simplifiers, I'm Evan, and today's conversation is going to challenge everything you think you know about investing and your portfolio. My Canadian guest has over 40 years of finance experience, from the trading floors at Citibank to launching his own boutique hedge fund. I'm sitting down with Anders Kruus. He thinks about finance like building with Lego blocks, taking different pieces and putting them back together to create something more useful. What makes his approach compelling is his frustration that sophisticated institutional tools never make it down to regular successful people. While institutional players have access to complex volatility management, everyday entrepreneurs are stuck with the basic portfolio options that keep them doom scrolling through the financial news. Today, we're diving into how Anders uses derivatives to reduce portfolio volatility, why he only invests in securities generating regular cash flow, and his diversification strategy across REITs, pipeline partnerships, and other endeavors. We'll also explore his leadership insights and why he wishes he stopped trying to fix broken toys earlier in his career. So whether you're tired of portfolio volatility or looking for institutional level strategies, Anders offers a refreshing perspective on building wealth without the stress. Let's go. We've been getting to know each other the last month or so, and I just really wanted to bring him on in order to share just his insights in finance the last 40 or so years. Anders, how'd you get started?
Well, as you know, I am Canadian. I was born to, I've been down here in the States for 30 years. I like to say I'm a Tunix. I was born to Scandinavian parents who raised me with many Scandinavian things, including playing a lot with Lego, which does come into how I think about finance later on. It's all just little different bricks and pieces you put together to achieve something a little more prettier and more dynamic and more useful for what you love. I've always had a deep love of economics. I subscribed to the Economist when I was 15, and I've kept that going ever since. Yeah, little detour into engineering for 1 year, and then after that, delved right into economics and finance, and I've stayed with that for the rest of my life. It's it's what I read in my spare time, along with some fiction, of course. I'm not a total freak, uh, but I still find it fascinating. It's the machine, it's the engine of the world. To me, that's what I love about economics and finance. It's how we all work together as a giant human society to make things better for people. Some more than others, but nonetheless. I got started naturally starting in finance and economics, and I grew up in Ottawa, which is the federal capital of Canada. Very natural for an economist major in Ottawa to go to the federal government, which I did for one brief year, just enough to see how government works and figure out that wasn't for me. Ran off to do an MBA in finance at the University of Toronto, and from there got recruited into Citibank, the big American global bank. Had a wonderful time with them over 10 years in Frankfurt and London and San Francisco and Toronto, working primarily to start with on trading desks in derivatives and in bonds and in foreign exchange, working with some some of the world's largest institutional clients, and ultimately migrating over to work with their private bank team for high net worth individuals. Since I ended that in San Francisco, sort of right in the peak of the dot-com era, I skipped out and then ran off and did a dot-com, but we did it in 2001, so it didn't start and it didn't go up.
No.
It was like running for the ferry as it takes off, and you didn't quite make the dock. But it was a great experience, and I went to banking for a while because I had a young family with Bank of America. And they eventually moved me up here to Seattle, where I'm based now primarily, to run a private wealth team, and then moved from that to corporate finance, working with small to mid-sized businesses, helping them arrange and organize their financing and their funding and their banking and their planning, and have also throughout all of that worked on my own portfolio, especially coming out of active broad experience in the markets. I've always thought of it a little like Lego. There are bits and pieces you can put together to achieve something closer to the profile or the outcome that you want. There's no magic, but there is ways of organizing things in a better way. I've been beavering away on that for 25 years from my own portfolio, and have been successful enough at that I'm now starting, as of tomorrow, my own boutique hedge fund will be open to investors, a small number for a small amount, because I know I can serve them and help them get a better return profile than what they're getting just with straight investments in the equity markets.
Wow. So, I mean, that's so many just amazing paths that got you to where you are today. I
Yeah.
mean, let's talk about just some things that you discovered when you were on trading floors and you're figuring out how things work and like you said, fitting together the little Lego pieces.
Well, I was so fortunate. The first boss I had in Frankfurt for the trading floor there, I was working in a bond derivatives group, which even when I get asked now, for advice for young people going into finance, those are actually the two things you need to know most is how to do the whole net present value cash flow calculation thing now and into the future. That's all bonds. And the other one is optionality. So working with calls and puts and the probability structures behind them and volatility skews and time structures of volatility. And that was all the options part. I ended up having to do both at the same time with a boss who was passionate about teaching his team, which I'm so grateful for to this day. Peter, if you're out there, I hope you're buying tons more Land Rover Discoveries. That was his passion, was collecting Land Rover Discoveries. Um, and from then, I've been fortunate. Everybody has good managers and bad managers. I've had some enormously fantastic managers that have been very promotive of my growth and supportive, both in sometimes letting me go in my own direction and sometimes supporting me in it. But what I did learn over time was that there are all of these tools that there's the entire capital markets that exist primarily for very high, uh, for institutional corporations, big pension
Right.
funds, sovereign funds, large hedge funds. It trades quickly. It trades
Mm,
liquidly. It's with very little friction between buying and selling. It has every kind of variation of risk return, manipulation, organization, and trade-off that you can imagine. But it's not being brought down to retail investors. And when in finance, when we
right.
say retail, we mean normal human beings, like everyday
Right.
people. They can be enormously successful in their business, but they're not in finance as a profession. So that's what we say retail. And of course, they split retail into high net worth, where people have enough savings that they're able
Hmm.
to start moving them around a little bit more. And then everyday retail. Um, it's always frustrated me that we don't bring finance down and use all those amazing tools that are out there to do a better job for normally successful retail individuals. That's one of the reasons
Right.
I started this little boutique hedge fund, which really is, it's got one offering. It's really simple. It's really transparent. You can figure out what the return should be yourself. We can talk about that later, or people can always go check out the website. Um,
Yeah.
and that, but behind it is all of the complexity that I've learned to manage over time.
So what were some of those complexities you're like, okay, either I've got to, boil down and kind of figure out how this works. I've got to be able to simplify this. What are some of those nuts and bolts?
Yeah, so individual securities in the markets, they trade what you could call, they have some individual components specific to that company, let's say, or that particular security, but a very large part of their price behavior comes from what we could call factors, especially if you consider the broad markets like the S&P 500 or the Russell or what have you, wherever they're listed as one factor. Other factors could be exposure to their currency. Other factors could
Hmm.
be exposure to interest rates. So those factors can be managed directly. There is for example, futures that trades specifically on the US dollar index, so on the value of the
Hmm.
US dollar relative to a basket. If you had a security that you liked for its performance profile that was especially exposed to currency movement, let's say because they did a lot of export business, you could
Okay.
hedge off the currency risk. In finance, we say risk when we mean volatility. I always prefer when
Hmm.
normal human beings say risk, they mean bad. When finance people say risk, they mean bad or good things, but it's moving around a lot. So I'll try to use normal human speak. It may have a volatility that comes from the exposure to the currency. You can get rid of it. That piece you can get rid of by offsetting it with a futures contract, for example, in the currency. So my investing has focused around finding securities that I like for their cash flow profile. They're generating strong returns. That's month over month, quarter over quarter cash, and then taking out as much of the risk as I can with all of these dynamic factor evaluations, which you have to do. They change all the time. So you have to evaluate them all the time using regression and other mathematical and financial techniques. Then you have to find products or instruments that can help take that risk, that factor volatility away. So you're left with ideally just the nugget of the good security generating strong cash flows for you as an investor. But you can never get there perfectly. There's always a little bit of wiggling around the edges because things don't stay steady anymore, ever.
Right. But that's the reason why you diversify a little bit, right? You don't just want to ride the roller coaster waves. You want to be able to smooth out some of those turns, right?
Well, the reason to try to do something, diversification is one way of trying to get your whole portfolio to not go up, be as volatile as you want. We know that you need to be invested. Equities are the strongest way, US equities, in fact, are the strongest way in the very long term to get returns, but they're also one of the most volatile ways to experience it. And it's really, really hard when you watch your portfolio, your savings, your life savings that you've squatted and worked. You took risks in your business, real risks in your business to try to get there, maybe or in your career or in your profession, and you paid taxes on it. And now it's safe cash and you're putting it in savings for your future plans, and then it gets cut in a third in 6 months.
Right.
So that's a life-changing event happening in front of your eyes if it persists. We know that it tends not to persist, but when it happens to you, it's like getting hit across the face with a piece of wood. Like you just can't cope with that. And so if you have to cope with that to try to stay invested, it's extremely traumatic and stressful. And many, many people bail out. And then they're not invested, and then they don't know when to come back in, and then they're not in for the long run haul. So the product I work on is get those volatilities damped down. So when the market goes down 30%, you're only going down 10%. You can see all the scary headlines, and you can go like, oh, I'm only down 10. All right, life plans are still on track, and that's the key.
Right. And I mean, that goes into sleeping well at night. That goes into like just the stress of life. And you're just like, okay, I need to be able to, set some things aside. I need to be able to, think a little bit differently,
Yeah, the old adage in finance for security selection is sleep well at night securities, swan securities. But that's pre-social media. Now, I think, yes, you want to sleep well at night, but when you're getting your highest level of anxiety or not when you're thinking about it, it's when you're getting hit all day long. So I like to say to my prospective investors, look, the goal of this is to help you not just sleep well at night, but also focus on your life during the day. You've got your work, whatever that may be, is probably, if you are successful, it is consuming an enormous amount of your time and your thinking. You've got a family, probably, that consumes a lot of your time and your thinking, and it should allow you to. You've got hobbies, you've got friends, you've got groups, you've got associations, you've got church, you've got all these other things where there actually is a reward for engaging in it. There isn't a reward for you engaging and watching doom scrolling about the stock market. You're not going to be able to do anything about it other than hurt yourself by getting out when you shouldn't and not getting back when you should. So let's get that volatility damped down so you can look at it and just set that stuff aside.
And those are really, the external forces that we all have to face. We all have to, wake up every day and go, okay, what decision am I going to make? Am I going to bury my head in the sand? Am I going to, just consume everything? What's like, for you, a middle ground? What's more of like a neutral centrist maybe place to be able to go look for news, to be able to look for insights?
Well, look, I like cars, plenty fine. I know nothing about them. I can only imagine if every morning when I woke up, sometimes randomly the engine light blew up and said, it's really, really urgent that you get into the mechanic. And then I felt I had to make the decision, first of all, whether to go to the mechanic or not and take my car off the road and when I should bring it back on again, and without even knowing what was going on underneath. And maybe it wasn't even going wrong. Maybe it was just, as has happened to all of us, just an engine light failure that caused an engine. Right. I had that in my Jeep for 4 years. So you don't want to do it with your car. Let's not do it with finance. Let's have something where you put your savings aside and you know what it's going to do. You can look at the broad market. You are going to have some volatility to have the long-term gains. It's about damping that volatility down and putting a bit of a modification on it. So our program at SteadyStocks is put the S&P 500 exposure. That means the volatility, and then we're able to add a 6% steady growth component every year. So if the market goes down a lot, you only go down half of that, and then you get a little 6% bump as well. If the market goes up a lot, well, you only go up half of that, but you get a 6% bump. In that plus minus 20, 30, 40% range that the stock market does sometimes, that makes a material difference. It's never going 100% in a year. You're not ever going to lose that much on the upside. And you're definitely cutting the big downside swings. The whole goal is to cut downside exposure out so much that you can comfortably stay invested in the program, and therefore we can get you those long-term stock returns.
Right. And, what are some of those sources that you're, filing through, news, you're looking through spreadsheets, you're figuring out, what are the best places
Well,
to invest?
I'm not looking at news because that's part of my whole investment mantra is we know good investment, and you can, if you read about and you listen to the interviews of some of the top hedge fund managers, they're not really watching the news.
Nope.
Other than maybe the macro funds. What they're doing is building programs, programmatic investing. That doesn't mean it's written in a computer. It often is. Mine is sort of partially, but it means establishing programs that you can consistently use time and time again that manage the market profile of your investment profile. So I'm looking at individual securities. I'm looking at a range of analysts that there's so many people out there offering a well thought opinions. So I have a pool of 100 analysts that I've looked at over time that I've picked as knowing what they're talking about. They all have different perspectives, right?
Sure.
So it's important to read multiple ones, but you find securities. Number one is, do they have a solid, stable cash flow yield based on where we're buying them today? The second question is, if you see that, that's kind of a filter. Next one after that is, where's it coming from? How stable is that? Next one after that is the company reasonably well run so we have a good opportunity to believe they can consistently keep grinding that out? Then put all of that, get a whole bunch of diversified ones. So I've got stuff from real estate income trusts. That's all kinds of real estate, both in America and overseas. We look at pipeline partnerships. We look at gas tanker businesses. I look at covered call selling securities. We look at some that are just biz dev. They're called business development corps, BDCs. They're basically mid-market lenders to companies between sort of the banks and the bond market. We've got international stocks that look at emerging market bonds. We've got some mortgage REITs that are basically intermediaries in the mortgage market. So all of that plus more. I don't really care where the cash flow comes from. In fact, I prefer unusual cash flows relative to what I've already got in the portfolio, because if I can diversify it, you're always going to take some hits. Something's going to trip. Somebody's going to miss something. They have a bad bond in their portfolio, which causes a ripple. So if you diversify, you have a small manageable level of loss against your total portfolio's cash flows that stabilizes that. And then you knock out the factors. I run multiple regressions monthly to see how exposed is my total portfolio, the long-term rates, the short-term rates, to the S&P 500, to the Dow, to the Russell, to international stock indices, to gas prices, to oil prices, to gold prices. And those exposures will change. Some of them are meaningless at points in time. Some of them actually have meaning because the market character changes over time. That's what makes investing so hard. Even after you find something successful, the whole market changes. Look at what's happened in the last couple of months.
Right.
With administration. The paradigms and beliefs that you had that worked last year this time do not work today. You have to shift it. And you have to find a way to shift your program without running out there trying to take personal discretionary thought. And that's what kills all of us, is if we put our finger on the scale, as they say.
Right. So what are you seeing right now, amongst all those, various, avenues and different ways to be able to diversify your own portfolio? What are you seeing as, hey, these are the top few that, you need to keep your eye on?
I think I always like the comfort of cash flow in companies. So nothing, as we've talked about, you and your listeners would guess by now, I don't have anything in my portfolio that doesn't generate a dividend or an interest payment or some kind of return on a regular basis, monthly or quarterly. No
Right.
less frequently than quarterly, because a company, if it only has an annual dividend payment, it's for a reason. And the reason is they don't know exactly what it's going to be for the whole year. So they
Sure.
will only distribute if they know what it's going to be. If they've moved to a cash flow generating business, then they tend to distribute quarterly or even monthly. If they're still using a lot of their internal cash flow for investment, quite
Hmm.
rightfully, to grow the business, they're not going to distribute a dividend more than annually, and sometimes not at all. They may do stock buybacks like Apple doesn't tend to distribute much of a dividend. They return money
Right.
to their shareholders through stock buybacks. Why? Because there's still a fair bit of fluctuation in the cash that they have available to send back to their shareholders. That's not for me. It doesn't mean it's right or wrong, but it's not for
Mhm.
me. Um, if for investors who want a little more stability in their portfolio, I would encourage them to look at mortgage REITs. I would encourage them to look at natural gas pipeline and oil pipeline partnerships. They're called MLPs. I would
Hmm.
encourage them to look at REITs, real estate income trust. There are all kinds of those out there. I'd encourage them to look at some bond funds. So have some high yield bond funds, junk funds, whatever it is. Have some stabilized stocks. You could look at preferred stocks as well. There's a large variety of opportunities out there, but you should have it diversified ideally across as many things as possible. A little bit of this, a little bit of that, so that if one sector, for example, mortgage REITs are
Right.
quite sensitive to interest rates. If something untoward happens with interest rates, your whole portfolio doesn't do a dive, causing you to panic, freak out, spend your whole day doom scrolling, and then probably fall out exactly when you should.
Right. Could you break down, I mean, even just like a range, or you're even just like a minimum, like if you were to go and go through a REIT, go through pipelines, go through, would you like break down what that would typically be for an investor if they were just doing it themselves?
If they were doing it themselves, you can buy in for like the securities trade down and $5, $10, $8,
Hmm.
$100. So it's not like it takes a lot of money to get it done, but you do want to be able to sit down and analyze which sectors are they. Like you don't want to
Right.
accidentally dip into a bunch of securities that are all interest rate sensitive. So, for example, I have six big buckets for my portfolio. I have U.S. equity focused or factored. If we go back to that thought about factor sensitivity, I have international, so they're very sensitive to the performance of international versus US. I
Hmm.
have credit, which is basically stuff like high yield bond funds, and even preferred equities that are very much sensitive to the changes in the credit market. I have a mortgage REIT bucket. I have an energy bucket, so that's all focused around oil and gas primarily. And then I
Right.
have what I call just utilities bucket. So that could be a utility fund. It would
Hmm.
also through real estate income, utilities, it's infrastructure really is a better name for it. That's utilities, it's real estate. She found out there's airport stocks, there's highway
Right.
stocks, all those that sort of own something physical that continues to generate cash.
Are you getting access to some of those institutional, um, investment opportunities, or are you,
I don't,
um,
I don't
how are you
really
breaking things up?
I wouldn't, many of the large institutional opportunities are also illiquid. Meaning, when we say
Right.
liquidity in finance, what we mean is how easy and expensive is it to get in and out? Right?
Hmm.
So, for example, many private equity funds, the private equity funds are very illiquid. They often lock you up. They say, we'll run
Right.
your money for a while, but you can't have any money back for 5 years or 10 years or 6 years or
Right.
whatever
We're
it
gonna
is.
hold it. Yeah.
That doesn't make sense for how I run my portfolio because I'm constantly adjusting the size, the balance between the sectors, and the diversification elements. And I have stop losses running on individual securities and take profits. You can't
Yeah.
run a stop loss or a take profit on an illiquid security. It doesn't work. So
Right.
I only look at highly liquid securities. I only look at stuff that trades fairly smoothly in the public market. It's still a giant universe for me. It's also why I can only run our SteadyStocks program, our boutique hedge fund. Regulations say only 100 investors. I don't think, maybe we've set the first cap at 10 million. I might be able to take it to 20, but like I couldn't run 100 million because it's
Right.
just going to be too much to be placing in the market, going in and out. often daily, not on every security, but I'd say I trade at least 4 or 5 times a week, 4 or 5 days a week I'm trading. And I need a lot of liquidity for that. So there's a limit to the size that you can manage.
Right. Right. That's huge. What are some of, more of like just your own personal, endeavors with, like you're saying, books you like to read and, maybe even just some leadership that, things that you've learned over time?
Sure. Well, obviously, I like to read economics and finance. I do a lot of it.
Yeah.
I mentioned that. I do love science fiction as well, especially the newer science fiction, fantasy, historical fiction. It's my way of getting away from the day to day
Right.
anxiety is to escape into well written worlds, if you will. So those are.
Uh-huh.
I don't tend to read a lot of direct biographies, but that's my personal choice. We all have to find ways to calm ourselves and reground ourselves. Weirdly, I find a lot of well written science fiction, fantasy, and historical fiction has to relate. The good stuff relates into the common characteristics of human beings and how that might
Right.
end in other scenarios than what we're living in. And that's the fascinating part. So, as far as leadership goes, and I have led a number of teams, and I've led a number of remote teams. I've worked remote, for over 30 years for various reasons, worked with remote delivery of results or with remote clients, and I've
Right.
worked with teams who've been remote. Some of the best advice is kind of just collected from there's some great writers, Peter Drucker and so on, about
Hmm.
leadership. To distill it all down, you as a leader, you're not delivering the result. Your team is delivering the results. If you're a leader, you have a team. If you have a team
Hmm.
and you're delivering results, you're not the leader and you don't have a team. So your team delivers the results or you're not doing the leadership. So what becomes important in that regard? It's not that there's really 4 elements to it. And first of all, make sure you have a good team. You have a good team by being careful to get the right people on the team. Then
Right.
you have a good team by being very quick to get the wrong people off the team. It's not a personal thing. It's just
Hmm.
you don't fit. And sometimes people fit in a team to start, and then later on, they don't fit. Their aspirations, their needs, their skill set don't fit. You got to make those decisions quickly because if you have dysfunctional elements in the team, the whole team is affected morale and productivity wise.
Right.
So let's keep
Right.
build a good team. Number one, tell them what to do. Better have a clear goal for all, same goal for all of them, same common
Hmm.
single goal. It needs to be measurable, or they don't know if they're doing well. It needs to be
Yeah.
actionable, or they can't do anything about it. You can give us a team goal of increase the US GDP by 5% next quarter. We can measure it. We all share it. We can do nothing about it, right?
Right.
But I can tell my sales team, my private banking sales team, next quarter when we do surveys from customers, we need to increase our satisfaction score from the last one of 3.5 to 3.75. Right? They can do it. They know how to do it. They can measure it. We can see it.
Right.
Final one is because the team's delivering the success, you've built a good team, you know what the goal is, get out of the way and get everything
Right.
else out of their way. Do what they need, support their success, promote their success, stand behind them, get things cleared out in front of them, get them whatever they need to be successful, then you'll be successful. So it's a bit of a servant style leadership. The pyramid, the hierarchy pyramid is upside down. Delivery is
Flipped.
up, then you're down at the bottom. You are holding it all up, but don't get too arrogant.
That's so true. That's so true. What would be just, one or two things that the past like 4 decades you've figured out, okay, man, I could have gone a little smoother, a little faster, a little bit easier, but it's not like a coulda, shoulda, woulda. It's like,
Yeah,
okay, this is how I can
reflect.
prepare for yeah, reflect and prepare for the future.
Yeah, I'm a fan of reflection. I don't think regret is worth it. Regret is a useless
Yeah.
emotion. Reflection is a useful emotion to a limit, so long as you're keeping it conscious. I would say my life list has helped me enormously in improving my confidence and recognition of my talents. Growing up in a Scandinavian family, they're not actually a lot of it's a very humble culture.
Mm.
So you're not allowed to get above yourself, but sometimes that means you're below yourself. So I would say, looking back, I know I would have been further along in my goals, ambitions, and achievements if I had recognized earlier that I was very talented at the endeavors that I was trying, and that therefore I should have demanded opportunities that matched my talents and not settled for other. And in particular, I shouldn't have tried to fix so many broken toys. And that goes for relationships as well. I think we talk about it for relationships. Be careful about trying to fix a broken toy. I've been there. We've all been there. I think I've been there a little too often. Definitely not now. But I think it applies to work as well. You can go in and try to fix a broken toy of a team or a business or even a product or a whole structure. And because there's a part of you that thinks you're talented and that you can do it, but weirdly it comes with with humility at the same time, where you don't think you're worthy of a better team or a better set of circumstances. I wish I'd figured that out. No, it's not my job to fix the broken toys. It's my job to do the best with functional toys.
There we go.
Yeah.
And that's what you're putting your hands to now. That's what you're doing.
Absolutely. Yeah. I think it's just about providing just an alternative investment profile for retail investors. I can't fix the ones that don't know what they're doing. I can't fix the ones that think cryptocurrency is the way to the future. I can just offer an alternative for those people for whom it makes sense.
Well, Anders, what's a great way for people to get to know you, to stay in touch with you? Probably LinkedIn, right?
LinkedIn's always good, and email's not bad either. Through our the website is investsteadystocks.com. We just set that up, so you can email me through that. You can connect with me through LinkedIn. Happy to hear from anybody and connect and hear their stories or offer advice where they want it, and hopefully not where they don't.
Good deal. Well, Anders, thank you so much for coming on. Thank you so much for bringing 4 decades of wisdom and distilling it down.
Thanks, Evan. Thanks for letting me run on.
Anders' 40 years in finance boils down to one powerful realization. Institutional level portfolio management doesn't have to be complicated or stressful for regular investors. His approach of building steady cash flow while systematically reducing volatility lets you stop doom scrolling and start living. And probably the biggest lesson for me is sometimes the smartest move is recognizing what's worth fixing versus what's worth just walking away from, whether that's investments, teams, or entire business strategies. You can learn more about Anders and his approach at investsteadystocks.com or find him on LinkedIn. Just take something from this conversation and put it to work. Until next time, keep it simple, Saints.